Good afternoon, ladies and gentlemen. My name is Michalis. I'm one of the market analysts here at HF Markets. I do apologize for the delay starting. Unfortunately, I had some technical issues with PowerPoint. Also, because of that, unfortunately, I won't be able to use the PowerPoint pen, but of course, I will be able to show and continue the webinar on PowerPoint as normal. We will at some point, of course, also be going on to M25. I'd like to welcome everybody to the first webinar of this week. This webinar is largely aimed at beginner traders because it's about how to read and analyze the price charts. So we're not going to look today in anything at anything in regards to in-depth analysis. We're not going to look at, for example, order flow trading. We're not going to look at the VWAP like we did last week. We're not going to look at advanced trading strategies or anything like this. Today is a great webinar for those individuals who have very recently joined the financial trading markets, joined HF Markets, and is looking to get a better understanding of how to read and analyze the price charts. Now, before we get started, as part of today's webinar, I'm going to release a poll. Now, we released a poll approximately 2 weeks ago, and we asked everybody if they believed that the US dollar in September will increase in value or decrease in value. And it was more or less 50-50. It was 48% in favor of the US dollar increasing in value, 52% in favor of the US dollar decreasing in value. Now, we don't know the answer to that yet, if people were correct or if people were incorrect, because of course it's not the end of the month just yet. But I wanted, because people kept asking me, let's do some more polls, let's see what everybody else thinks about the market as well. So I wanted to release a poll about something which is imminent, so something which is going to take place in the next 24 hours. So we released a poll just now. Will tomorrow's CPI data, so tomorrow's US inflation data, read higher or lower than expectations? Ladies and gentlemen, don't forget, this is going to create so much volatility, a lot of volatility, ladies and gentlemen. So this is a very important poll, a very important question. Will tomorrow's CPI data read higher or lower than expectations? I want at least 50% of people to vote either if it will be higher or if it will be lower. Now, it's expected to come in approximately at 2.6%. So higher will be 2% and above. Lower will be 2.5 and above. For it to come in as expected, it will come in at, of course, 2.6. So we need at least 2 more people to vote, 1 more person to vote, and then I'll share. There we go. So most people now have voted. I can see quite a lot of people are voting. Actually, quite a few people are voting. So I'll keep it open a few more seconds, and I will release what the answers were. So will tomorrow's CPI data read higher or lower than expectations? 73% believe it will be higher than expectation. Now, I didn't actually expect that, to be honest. I understand why, but I didn't expect that to be the result. 27% believe it will be lower than expectations. So that's something very, very interesting, because if we think about the last 30 days, for example, oil prices have decreased by more than 15%. So the fact that individuals believe it will come in higher than expected is very interesting, very interesting. But either way, let's continue with today's webinar. So as part of today's webinar, of course, these webinars are here for educational purposes. Of course, we don't give investments or financial advice. Even though I'm a licensed financial advisor, this isn't the purpose of today's webinar. But what we do want to do is give as much educational material as possible in order for you to be able to be active in the financial trading markets with knowledge, with expertise, with confidence, and know exactly what you are doing. As part of today's webinar, I want everybody to be fully aware as well that as part of these webinars, it's not just necessarily a presentation. You write down notes, everybody learns something, but it should also be very similar to a conversation. Ask questions, ladies and gentlemen. Yes, it's a presentation. Share what you've experienced. If you're finding something difficult in the financial markets, share your experience. Tell us what it is. Tell us about it, and we'll find the remedies, the solutions live in today's webinar. Now, of course, today we're looking at candlesticks, we're looking at charts, we're looking at analyzing price charts in a very simple way. It could be something, you may be a more experienced trader and you're looking for some answers and remedies and solutions. That's absolutely fine as well. Of course, today's webinar has been designed for beginners, but anybody, whether they're a beginner, whether they've never traded before, whether they fit in that bracket, between a beginner and an experienced trader, they're somewhere in between, have been trading for 6-7 months, for example. Those people tend to actually have a lot of questions. Even though this is for beginners and in the beginner category, ask questions. Tell us the difficulty. Tell us your experience, and we'll look at how we can find answers to this, of course. Somebody says he cannot hear. Is anybody else finding difficulty hearing? If people can please confirm if they can hear me or not. If you can hear me, just write a very quick comment. Yes, I can hear you. Okay, so everybody here I can see saying they can hear me. So it looks like it's your computer. Maybe log out and then sign back in. But I can see everybody can hear me fine. So a little bit of information about myself. And then we're going to start straight away looking at understanding candlesticks, charts, pattern breakouts, false breakouts, solution for false breakouts, Fibonacci, and so on and so forth. A bit about my background. I've been in the financial trading markets for 10 years. The first 4 years, I was a financial advisor in London. For the following 6 years, I actually was a market analyst in many different countries around Europe. Part of those, partly I've been in Romania, I've been in Serbia, I've been in Cyprus, I've been in Greece, I've been in Turkey, because I do a lot of traveling, a lot of seminars globally as well. I've even been to South Africa, to Dubai, and a lot of different countries. So that's a little bit about myself. It's not necessarily important to today's webinar, but I want people to get a good understanding about the person who is providing you with this information. The main thing I want people to feel is comfortable to speak to me. A lot of people, they see a lot of educational videos online and on social media. 99% what they're teaching you is not something correct. It may be correct sometimes in theory, but the real financial trading market isn't like that in any way, shape, or form. They'll find the most perfect example for you and say to you, trade in this way. And to be honest, yes, if you find that example, yes, it is easy to trade, and yes, you can use those techniques. But the difficulty is that during the financial trading markets, about 25% of the time you're seeing those price conditions. So a lot of people, they struggle to speak to somebody, to find somebody who can actually help them. Myself, if you go onto CySEC's website, you can actually see that I'm licensed and a certified individual as well. So that's the reason why I always give a very quick slide, a very quick introduction about myself. Now, before we start looking at price action, analyzing the charts, everybody should know there's 3 different charts that's going to be available to you. So for these beginners, everybody here, you're probably signing into your account and thinking to yourself, the first thing I can see is, yes, I can see different assets. Some of those assets I'm familiar with because they're household names. Everybody knows what Apple is. Everybody knows what stocks are. To be honest, nowadays, everybody knows cryptocurrencies, and everybody knows some of these very popular indexes, should we say. For example, more or less everybody knows what the NASDAQ is. People may not know the DAX, the CAC, they may not know the Nikkei 225 and so on and so forth. But for example, the NASDAQ, it's more or less becoming a household name. But then they start looking at candlesticks and they start thinking to themselves, okay, so I have to pick one of these charts. Which chart should I pick? What is the difference between the three of them? I can see I've got three options here, and which one is the best? So everybody should be aware there's three charts which will be available to you. Of course, myself, I can tell you within the financial trading markets, there's mainly four charts. Here, there's going to be three which are available to you. In the financial trading market, especially with large institutions, there's four charts. And I'll explain and confirm what the fourth one is. Now, the first one, which looks the most simplest, is the line chart. So here you've got the line chart. It looks very simple, just a very simple line. What information does it give you? The line chart will show you the closing price alone, okay? It will only show you the closing price. So for example, if you're on an hour chart, it means every period is 1 hour. So the line will only show within that hour, where did the price close at? So for example, the price at the moment is here. This is the closing price. This is the price at the moment. But it doesn't actually show you that actually within that hour, the price was at some point all the way down here, and at some point all the way up here. And of course, if you had that information, it paints a very different picture. But you have no idea where the price has moved. The only thing you know is at the end of each hour, where did the price end at? So it doesn't really tell you much about the asset itself. So for example, if I said, let's say everybody here, because I can see it gives me statistics here, this platform, and it says to me that 47% are male. So probably most people like to watch football. So if we look at a football match, it's like saying, I won't show you the statistics of the match, but the end result was, for example, 5-1. Okay, so everybody probably thinks 5-1. The team that won 5-1 is definitely dominating throughout the whole of the match. Whereas if I showed you actually the statistics, maybe it was 1-0 they were losing up to the 88th minute. And in the last 5 minutes, for example, they scored 5 goals, in which case that changes the picture massively. So the line chart is very similar. It only will show you the end price, and that's a big issue. The second and the third show you the exact same price. It gives you the exact same information. So these are known as candlesticks. Okay? These are known as bar charts. Now, if we're looking at candlesticks, there's two types of candlesticks. And the same applies as well to bar charts. You can see there's the green and there's the red. If we look at examples I actually took last night, you can see we've got green, red, green, red. Even if you look at the bar charts, again, is the exact same scenario: green, red, green, red, green, red. So if you're looking at the bar chart, the candlestick chart, sorry, if it's green, it means the price rose. It meant the price increased in value in that period. So you've got to keep in mind each candlestick will represent a specific period. So if you're on a 5-minute chart, each candlestick will represent 5 minutes worth of trading. If you're on a daily chart, it will represent 1 day's worth of trading. So if it's green, it means in that period it ended higher. If it's red, it means in that period it ended lower. So what prices does the candlestick give? It gives you 4 prices. It will give you the open price. It will give you the closing price. Okay. It will show you in that period the price declined to its lowest point here and to its highest point here. So it's basically saying where the body of the candlestick opens, which is here, that's where the price started. By the end of the period, this is where it closed at. But in that period, at some point, it went as high as this and as low as this. So this is why you have the wick. So there's two parts of the candlestick. You've got the body of the candlestick and you have the wick on either side. So this is the four prices that the candlestick gives: the open price, the close price, the high and the low throughout that period. Now, if you're looking at a price where the price is declining, so a bearish candlestick, it gives you the exact same. But of course, here on the top left is where the price opens. Here at the bottom right is where the price closes. Whereas with the opening candlestick, this is the open and this is the close. Now, if you're looking at the bar chart, it's the exact same. The only difference is that it's visually different. So instead of it being a candlestick, you can see, for example, you've got a little line here, a spike. That's how we know it as financial advisors, as traders, as economists. This is the spike of the bar. This spike, ladies and gentlemen, on the bottom side and on the left side is where the price opened. This is where the price closed. This is where the price opened. This is where the price closed. This is red because the price opened here and it closed lower. So it's a bearish bar chart. So there's no difference between the two other than that it's visually different. Now, somebody's probably going to say, which is the best? The best, ladies and gentlemen, is candlesticks. Now, that is a fact. It's not, an opinion. Out of those three, the candlestick is the best because it provides the most information. Bar charts also provide the same amount, but visually it's easier to analyze because it's giving you the body of the candlestick. Now, large institutions, okay, they will use what is known as an order flow chart. This is something you can research as well, especially if you've got some traders that have been trading maybe 6 months, 10 months, whatever it may be, and they're thinking to themselves, I've got a good understanding, I've got a good success rate now, but I just need something to push me on to more expertise and advanced trading, in which case you can use order flow charts and order flow analysis. Now, we do have webinars where we look at this, of course, but today's webinar, we're not going to look at that because it is more, today's webinar is more for beginners. Now, what's the difference? An order flow chart will look exactly like this, like the candlestick chart. The only difference is within the candlestick, it will show you how many people are buying, how many people are selling. So, for example, in this candlestick here, it will show you, yes, it's a bullish candlestick and the price is increasing, but there's 1 million people buying, 200 million people selling. So it's 5 to 1, should we say? So that's the difference. So of course, there's a lot of benefits to order flow as well, but definitely something more difficult for more experienced and more advanced traders potentially. So I've got a question here. Let me quickly just answer this question. Okay, so he's asked which is the best. He asked before I confirmed which was the best. So hopefully that has answered this question. We have already answered your question. Right, so price action trading. Price action is basically the analysis of the price movement. And this is what we're concentrating on today. A lot of people, they look at indicators. To be honest, when we're looking at professional traders, because I've worked a lot with professional traders with hedge funds and things like this, they don't really look at technical analysis indicators. A lot of people and educators online that say they're experienced and say they're very successful, most of the time they're not, to be honest with you. Now, I will be honest with you, professional traders, large institutions, they do not use technical analysis. They will say to you that technical analysis is 100% garbage. They largely will look at three things. They will look at price action, so to analyze the price blindly. They concentrate a lot on fundamental analysis. They concentrate a lot on order flow as well. The other thing I'll say they concentrate on a lot is the true value of the asset as well, rather than looking at technical analysis. Now, what I will say is that for beginner traders, because today's webinar is for beginners, certain aspects of technical analysis can be beneficial, because as a beginner, we do need that assistance. We do need at least something there, tools to clear up our mind and to really narrow down what options we have. Of course, as beginners, it is down to us to take that choice once it's narrowed it down. So instead of sitting in front of the screen and say to yourself, I have no idea what's going to happen, maybe 10,000 different things are going to happen, indicators and technical analysis will be able to narrow your thoughts down to maybe 3-4 things can happen, and then it's a much easier decision for you as beginners. Now, what professional traders do concentrate a lot on is price action trading. So price action is the analysis of the price movement. Investors use price action to understand the current price condition and potentially where the conditions may change. Traders use price action to determine the entry and exit points. So in order for you to be a successful trader, you need to be able to successfully be able to determine where to enter and where to exit. To be honest for you, like we actually looked at in the last webinar, this was in my latest webinar a few days ago. What we looked at is when you become more experienced, and I actually showed exactly how to do this and actual examples of this. A lot of people, they sit in front of their screens and they're trying to trade live and they're thinking about that next trade. They don't know where they're going to trade it. And before the trade is open, they don't know when they're going to close it either. Whereas when you get experience, you realize you actually plan your next 5 trades, not 5 trades on different assets. One asset, talking about a period of maybe 30 minutes, 1 hour max, you're going to know your next 5 trades. So the next 5 entries and 5 exits, regardless of what's going to happen within the market, even if it's going to be a mean reversion, if it's going to be a trend, if it's going to be the end of the trend, you fully plan the next 5 trades, regardless of what's going to happen within the market. So price action is going there. It's going to help you determine where to enter and exit. What's massively important is that you're able to successfully determine accurately when to enter and exit, because that's when you're going to become a successful trader. Price action may use indicators which are based exclusively on the price. So, for example, the volume weighted average price is not part of technical analysis. That is, yes, an average price, but it's based on volume, so it's not solely based on the price. So keep that in mind. Technical analysis is solely based on indicators where the price is driving the indication, not something else such as volume or fundamentals. The rule of investors is to buy the bullish trend, but at the lowest price possible. So if you've got investors, so somebody looking to buy and hold on to an asset, maybe 1 year, maybe 2 years, maybe 5 years, maybe 10 years. Actually, we released a video today where we showed the statistics of the NASDAQ, which was absolutely amazing. The NASDAQ over the past 15 years, only on 3 years did it end lower. So for investors, that's an amazing statistic. Over the past 15 years, the NASDAQ only on 3 occasions ended the year lower. One of those reasons was because of the trade wars quite a while ago, I think back in 2017, 18. The other one was because of COVID, and the other one's going back a very long time ago. So very interesting. Now, investors, like I said, they want to buy the bullish trend, but at the lowest price possible. There's a very big reason, important reason why I'm mentioning this. Buy, but at the lowest price possible. Now, traders is slightly different. Traders, the rule for traders is to get in and get out within the momentum. They're still investors. They still want to buy the bullish trend at the lowest price possible, and they want to speculate the decline to sell the bearish trend, but at the highest price possible. And at the same time, for us traders to be able to trade, get in and get out while there's momentum, so before the momentum is lost. That's something which is going to be very important. You understand why it's going to be very important later on in today's session. Now, price action. Now, I'm going to give you an example which I've drawn up, and in the next few slides, we're going to look at real examples that I've taken screenshots from the past week. Now, when we're looking at price action, of course, a lot of people, and especially if you're looking at beginners, they tend to want to concentrate on trends. Beginners, they have higher statistics and higher success rates where they're concentrating on the trend. When they're trying to trade mean reversion, try to trade against the trend, trying to trade a reverting market or trendless market, it's much more difficult because the price movement is 50-50. Whereas when you look at a trend, 75% of the price movement is in the direction of the trend. So there's a higher possibility of you being correct. So this is an example of a trend. Now, price action, analyzing the trend, analyzing the price, analyzing the charts. What I want to mention is there's always two types of waves. These are what are known as waves. Some people know them as swings as well. Either or is absolutely fine. Now, when you're looking at price action, you will always see there's two types of waves. The first is known as the impulse wave. Now, the impulse wave, ladies and gentlemen, is the price movement, which is a larger price movement, and it's in the direction of the trend. So, for example, if you measure this price movement, it could be, for example, 1%. Whereas if you're measuring this price movement against the trend, it could, for example, measure 0.75%. So the impulse wave is the larger price movement. So I've got the impulse waves in green here, okay? Now, then you've got the price movement against the trend. Now, these are known as the corrective wave. Now, the corrective wave can either form two types of price movement. It could form a retracement. So retracement is like this. This is a retracement. Why is it a retracement? Because the size of this impulse wave is much larger. And because this is the low, this is the high, the price lost momentum here. So it's a retracement because it lost momentum at a higher price. That is deemed as a retracement. It's not a new trend. It's not suddenly a downward trend. It is a retracement. So technically, we're still in an upward trend. This is the important thing. A lot of people think downward price movement is a trend ending. Is it now a downward trend? Shall I speculate decline? Of course, that's an option, but we're not in a downward trend, or at least not within a downward trend just yet. Then you've got another impulse wave, retracement. This is a retracement because it's a smaller price movement. Also, you can see this is the low. We've got a higher low as well, so we're still within an upward trend. Then we've got a higher high, a retracement. Why? Because it's smaller than the previous impulse wave, so this is larger than this, so this is a retracement. Again, we're on a higher low as well. Now, where do we see a lower low? This, ladies and gentlemen, is the corrective wave, but this corrective wave has gone on to a lower low. And if we measured this swing here, it is larger, the corrective wave is larger than the impulse wave. So that's not a retracement, that is a corrective. That's a correction because it's gone to the previous low or it's crossed below the previous low. So at that point, we're no longer in an upward trend. Now, a lot of people will fall into the trap of thinking we're no longer in an upward trend, so the price is going to do something like this. The price may do something like that, It's not guaranteed though. The price, for example, may start to move up and down, and the sideways price movement may move sideways in a symmetrical triangle pattern, so slowly losing momentum, and then we'll have a burst and a breakout. Or for example, the upward trend can continue after that. So a lot of people are going to say, where does the upward trend continue? The upward trend will continue as soon as it goes on to a higher high again. So that's something for you to take into consideration. What you would need to think about is, why did we go on to a lower low here at this point? Why was there so much price movement against the trend? Is it because the price is now extremely expensive? Is it because we've had 1, 2, 3, 4 impulse waves already? Because you've got to think about, when the price keeps going up, people start to think about, should I cash in? And also a lot of buyers or potential buyers will start to say, do I really want to buy at such a high price? Don't forget, investors, like I said, a lot of the time, yes, they want to speculate the upward price movement, but at the lowest price possible. And it's no secret that large institutions, a lot of the time, they'll drive the price lower and be very happy to just buy at the lower price. So that's something for us to take into consideration as well. So we've got the impulse wave, we've got the retracement, we've got the correction. So we've got impulse and corrective waves. If we get a correction, it doesn't guarantee that we're going to see a change in the trend. Okay. Now let's look at this trend. It's a very recent trend. I took it yesterday. It's the US dollar against Japanese yen. Actually, Japanese yen is the worst performing currency of the day today, but yesterday was performing very well. Actually, over the past 2-3 months, it had performed very well, particularly against the US dollar. But here we've seen the US dollar increasing in value, and we can see exactly what I'm referring to. So for example, we've got an impulse wave here. This is a retracement, ladies and gentlemen. Why is there a retracement? Because it's a higher low, and if we measure the distance between here and here, it is significantly smaller than this wave. Then we've got the continuation of the wave here. So this is the impulse wave again. We have a retracement here. We've now gone almost to a correction. Some people may deem that as a correction. It's kind of 50-50, doesn't really go to that previous low. Either way though, it's either going to be a retracement or correction. Then we get another impulse wave, retracement, another impulse wave, retracement, another impulse wave, retracement, impulse wave, retracement, impulse wave, then we get a correction. So we're now on a lower low. So it's at that point we start to get an indication of, wait a minute, we're at a lower low. Is that trend indeed going to continue? Because we've now crossed onto a lower low. So now, if you look at this scenario, we've got a lower low and we've got lower highs. So what do we need to be cautious about, ladies and gentlemen? What you will notice is I've written here is, how many impulse waves has there been? Has there been 4 to 5 impulse waves? Now there's different theories and some people have different rules. A lot of people, for example, say, I will only trade up to 4 impulse waves. A lot of people say I will trade up to 5 impulse waves. Some people say I only trade the 3 impulse waves. So it depends on your risk appetite. What I will say is, the more the price is moving in that direction on the 5-minute time frame, this is a 5-minute time frame, guys, you can see this here. The more it's moving in that direction on the 5-minute time frames, the more impulse waves that you have, the stronger the possibility that the price will just collapse and move in the opposite direction, because people will cash out. Whether it's going to create a retracement, a correction, or a new trend, it doesn't matter. The only thing you need to know is stop buying, stop opening more buy trades. So for example, we've got 1 impulse wave here, we've got 2 impulse waves here, 3, 4, 5. So we've got 5 impulse waves. Anybody trading within those 5 would have been successful. Anybody trading the 6th, price would have moved against him. So again, it depends on your risk appetite. What you do need to be cautious of, if you get to that 4th impulse wave, maybe if you get to that 5th, start to think about it. Do I really want to speculate? Because for example, you could have traded this upward price movement, profited, you profited on the second, you profited on the third. A lot of people think, why continue to trade? Yes, there's still a lot of upward price movement here, but don't be greedy. I've taken the first 3 impulse waves, happy days. I've hit my take profits. My success rate today is amazing, great. Why do I need to keep on trading? So, but again, some people may opt for a 4th impulse wave. That's completely down to you. And also keep in mind, if you started to trade, let's say you're somebody who only wants to trade up to the 4th and not the 5th, if you only started to trade here, then of course you're not going to say I'm going to start trading 4 from here onwards. 2 have already formed, so you're only going to profit from 1, 2, and then stop. Okay, so it's not about 4 impulse waves for you, it's 4 impulse waves within the market. I've got a question, I'll answer that in a moment. The other thing I will say is look at 2 time frames. So for example, here we can see there's an upward trend on and multiple impulse waves upwards on the 5-minute. Maybe go on to the 2-hour. Let's see if we're also in an impulse wave on the 2-hour as well. So you're double checking the price action to ensure that the price action is accurate. The other thing I will say as well is change of trading session. The change of trading session is something you need to be cautious as well, because once the session opens, you'll see a lot of volatility. That may change though. And then after that, what you need to be cautious of as well is as the session starts to change, it starts to get close to its close. So for example, we're maybe in the European session and we're now at 12 o'clock GMT. The session is about to change. So maybe the price action will start to change as well. So as we're about to change session, a lot of the time we can see there's a change in the trend, a change in the price movement. So I've got a question. So somebody says, can you please confirm and explain the correction? Yes, I will do so. I'll explain it one more time. So the price moves up, okay? It could move down, but it's moving in the direction of the trend. Let's say it's an upward trend, the price moves up. This is the impulse wave because it's in the direction of the trend and it's a larger impulse wave. When the price moves downwards, what you'll notice is this is the retracement, okay? It's a smaller price movement against the trend. Because it's a smaller price movement, it won't go to the previous low. So then the trend continues. This is the impulse wave again. So you can see some large price movements in the direction of the trend. Price starts to decline, smaller price movement against the trend. A retracement again. If it's a retracement, it won't go down to here, so that got back down to that previous low, and then we get the impulse wave again. So hopefully that explains to you the difference between the impulse and the retracement. The impulse is the larger wave in the direction of the trend. The retracement is a smaller price movement against the trend. So how can people trade the trend? Okay, because we've analyzed the price movement. So we've gone to here. There's a couple of things we've mentioned. I'll mention one more thing actually as well, because somebody here I can see says he's an experienced trader. Sorry, he's been trading for 5 months, so he's slightly more experienced. So we've mentioned a couple of things: 4 to 5 impulse waves, the impulse wave, the retracement. If we're seeing higher highs and higher lows, we're in an upward trend. If we're seeing lower lows and lower highs, we're in a downward trend. As to always check 2 time frames, a slightly larger time frame and a smaller time frame. So for example, 5 minutes and 2 hours, maybe it could be 4 minutes and 1 hour time frame. That's down to you. And always be cautious as we're about to change the trading session as well. What I also will say is a lot of people, they measure the impulse waves. So people will measure the difference between here and here, because what they'll say is, if that's 1%, okay, and they'll measure between, here to the low here, and say, if that's 0.30% price movement, then I'm going to keep that in mind, because as the impulse wave starts to increase again, I may say to myself, the previous impulse wave was 1%, maybe it won't quite reach 1%. Maybe I'll say, let's try to aim for 70% of that just to be safe. They'll put the take profit at the price increase in 0.70%, for example. This is just an example. And then, as the price declines, they'll say if it's declining up to 0.30%, that's the exact same size as the previous retracement. So I'm quite comfortable to hold on to that. That's within its traditional price movement. I'm quite happy with that. And then, as we're going to continue to trade the upward price movement again, now I've got two values. I've got the 1% and the 0.70%. So 1.70%. If we're going to look at that over an average, we now have an average price movement upwards of 0.85, for example. So now we're working with the average, which is 0.85. So again, I'll say the average, maybe I'll look at 75% of that, and that's my next take profit. I look at the retracement again. Is the retracement the same as it previously was? So I'm always looking at the traditional price movement upwards. What is it? Because as we start to get, the traditional price movement for the week, let's say on Monday and today so far, unless I'm currently trading, I'll say to myself, past 24 hours this week so far, the average price movement upwards, maybe for example, is 0.50%. Maybe the highest we've seen is 0.70%. The lowest we've seen is 0.40%, for example. So, as the price is, maybe we've done something like this, I'll say if it's going to increase upwards, I'm going to put myself a bracket. I'll say, based on the traditional price movement, the highest it's ever gone is here. The lowest it's gone is here. And on average, this is where it reaches. So I've given myself that bracket, that target there. Now, most people will try and aim for just below the average just to be safe. But of course, people may say, I want to be ultra safe, and I'll look at the smallest. People may say, I want to be more daring. I've got higher risk appetite. I'll look at 75% of the largest price movement. So it's completely down to you. Maybe you'll take into consideration if you believe the asset itself is going to increase or not. So maybe you're thinking about tomorrow's inflation rate. Maybe you're thinking about interest rates. A lot of people think interest rates are going to decline by 25 basis points at the end of during next week. So that's maybe something that you may say, I don't want to aim for the average, I'll aim for the higher impulse wave. It depends. Now, I've also included here, ladies and gentlemen, a trend line. So that's helping us, because you can see as it retraces back to it, it helps us. This is the support level, for example. Also, we're saying to ourselves, the further away it gets from our trend line, it's at the resistance level. Also got the RSI, if it's ever going to increase above 75 or decrease below 25. I know it's overbought or oversold. If it's trading between the 75 and 50, I know buyers are controlling the market. If it's trading between the 50 and 25, and the sellers are controlling the market. So you can see how I'm using this to analyze the charts, to analyze the price. Now, breakouts. This is the exact same chart. USD, Japanese yen, 5-minute time frame was taken yesterday, the exact same. What options do we have in order to help us pinpoint where to enter and where to exit? Now, I'm given two options, because we of course want to trade the impulse waves. We want to trade the upward price movement because we're above the trend line. So that's indicating bullish price movement, especially here, between here and here. We're trading between the 50 and 75. So that's indicating that buyers are controlling the market. We can see we've got higher highs here, here, and here. The lows again are higher on each occasion as well. So a lot of positive indications there to indicate the upward price movement. The only area that I'm slightly getting cautious of is, after this retracement here from here upwards, I'm very cautious because we've had, 1, 2, 3, 4 impulse waves already. So only at that point I'm thinking to myself, okay, at 4 impulse waves, I've profited 4 times, let's exit the market. So there's different options. Now, if we're going to see small retracements, for example, here we've got very small retracements, only decline for 15 minutes, very small price movement against the market. In those scenarios, we can trade the breakout, okay? Because the breakout's very close. So that's one example. This is another example here. So it loses momentum here again, only for 15 minutes. So I'm basically go to the high. So as it does this, for example, I go and I place the high here. As it increases upwards, like so, as soon as it crosses above this area, so that's why it's known as a breakout, that's why I enter my buy. So, for example, this is where we had the breakout, this is where we had the breakout. Both are amazing entry points, ladies and gentlemen. We can see the price increased again, both profitable. Now, if we're going to see larger retracements, for example, this is a good area of a larger retracement. Also, this is a good area of a larger retracement as well. What you can do is add the Fibonacci retracements. Now, people can add their own Fibonacci retracement levels. I'm just using the tool to help me. So what I'm basically doing is I'm drawing the Fibonacci retracements between the high, and I'm drawing it all the way down to the low. So that you can see the low and the highs here. So here we've got the high, here we have the low. And then what it's doing is giving us lots of different lines here. Now, some people, they say, I want at least 75% volatility upwards for me to speculate the upward price movement. Some people will say, I only want 50%. It's up to you. I put here 65. Now, 65 is not 75, in which case I'm losing an extra 15%. It's not 50 because a lot of the time, it may be a scenario where, yes, there was an upward trend, it retraced, went 50% up, but then it did this, in which case it is following the traditional theory of a lower low and a lower high and downward trend, whereas I actually started to speculate upwards. That's not something I wanted to do. So that's why I've got 65. People can alter that. Maybe somebody's more interested in 70. That's down to you. But you can see here we have 65. So I've drawn between the high and the low. So we've got between the high and the low, and it's given us these lines. As soon as it increases above, and it increased above here, increased above here, and then it increased above here. People have got different options. If their retracement changes, because it's started to go into a slightly larger retracement, but still is a retracement, and then they drag the retracement level slightly lower, then you can look at 2 entries, because of course the 65 would change. Otherwise, it's just that 1 entry. So you can see as it increases in the favor of the trend again, as soon as it hits 65, you can enter your buy and speculate the upward price movement. Same here, if we had the retracement levels between here and here, probably retracement levels will probably give it to us somewhere here. So that's this level. Here again, as soon as it increases above that, you start to speculate upward price movement. Now, some people will say, why trade below the breakout? Why not wait for the breakout? And I'll tell you why. If you traded, for example, if you drew here, this is a retracement. The breakout level, ladies and gentlemen, is here. All right. So you're going to enter the buy, and then very soon after, the price moves into a retracement. A lot of the time after the breakouts, that's the pattern. So why trade at the breakout, whereas very soon you're going to be at the retracement, whereas you could have traded earlier. So instead of trading at the breakout, you would have traded, for example, somewhere here, and you would have never have gone into a loss. Yes, you would have gone into a higher profit. It would have retraced, but even regardless of the retracement, you would have never gone into a minus. So, and then you would have continued the upward trend thereafter. So there's a massive benefits to using Fibonacci levels and trading earlier when it's a larger retracement. When it's a smaller retracement, of course, you can trade at the breakout, because of course, if it's a smaller retracement, there's not much of a difference between the breakout and the Fibonacci. Now, there's different breakouts. We've looked at so far the breakout of the trend. So we've got the impulse wave, we draw the high like so. As it breaks out, it broke out here. That's where we're speculating outward price movement and so on and so forth. Same applies for downward price movement. For example, if it's downward price movement like so, this is the retracement, we draw a breakout, and then as it crosses below again, we're speculating downward price movement. But there's other breakouts as well. So for example, this is a flag pattern. Why is it a flag pattern? Because you can see there's an upward price here, and then it kind of has symmetrical kind of a retracement, lower lows, and it kind of looks like a flag. So this is why it's known as a flag pattern. Now, flag patterns broken out. Even if we're not looking at it as a flag pattern, to be honest with you, we're looking at it like this, of just that being a support level. It's broken out twice, and on 2 occasions it was a false breakout. So here we're looking at false breakouts because it broke below here. A lot of people may have been sucked into that trade. Price actually moved in the opposite direction. Maybe it would have hit your stop loss. If it didn't, happy days, started to decline again. But even so, I mean, this is a 5-minute time frame. Decline for 15 minutes, and then it just moved in the opposite direction. So we need a remedy for this. This is a big issue. A lot of people who try to trade breakouts. I mean, trading breakouts are amazing. They can be very beneficial. If you're trading breakouts in the right way and using different time frames, you're using the trend lines. So for example, here I've got the orange. So this is an exponential moving average. I've got my RSI here as well. If you're doing it properly, it can be beneficial potentially. But even so, you still get sometimes false breakouts, and you'll get it quite a lot. It's not like it will happen once a year. No, it may happen once a day. So you need to know the remedy and the solution for this. So what are the remedies for false breakouts, ladies and gentlemen? False breakout, excuse me, false breakout remedies. If there is a breakout, if it's the first breakout, keep it ultra short term in the breakout. So for example, if it's, let's get a different colored pen out. If it's, for example, should we say a sideways price movement like this, and you're saying to yourself, this is the breakout level here. You know, if it breaks out, if it does this, don't put your take profit all the way down here. Keep it short term. Keep it really short term. So for example, somewhere like this. So if it is a false breakout, there's a higher chance of you hitting your take profit. So let's say it hits your take profit, okay? Happy days. Let's say it still is a false breakout. Maybe it does something like this after. But the difference is now you've not got the same highs. Now you've got a lower high. So look at this. Now we're on a lower high, and we're now on a lower low as well. So it's a very different scenario now. Now, for example, we can use our Fibonacci levels that we spoke about before and look at the 65 points, for example. And then if it starts to decline again, then we basically don't trade the breakout, we trade the wave continuation. So remedy number 1, keep the trade ultra short term. Solution number 2, trade the continuation of the breakout, not the breakout. You can do both. Trade the breakout by ultra short term, then trade the continuation and have a larger trade. That's absolutely fine as well. Make sure the trade, the price is not overbought and oversold, overbought or oversold after the breakout. This is quite common as well. Avoid breakouts at support and resistance points. Very, very important. So for example, if you've got a support, should we say a resistance point here, and the price increases again, then it starts to move sideways like this, you know, avoid a breakout at that level. I've drawn a terrible line there, so bear with me. You know, avoid this breakout level. Why? Because you can see we're at a resistant level as well. So yes, we've got a breakout, but it's a resistant level. So avoid breakout at a support and resistance level. Avoid high volatility. So ideally, you don't want the breakout to be with high volatility. So you don't want it to, for example, be, let's say if it's a downward trend like this, and then you get high volatility like this, which is uncharacteristically high. So for example, it could be even maybe higher like so, because again, a lot of the time it will lose momentum, it'll just go straight back to that previous price. So instead of a breakout like that, instead, steady traditional price movement breakout. Okay, so this is also very important. Close above the breakout and wait for a more established price movement. So this is another option, another remedy. Work out the average distance between the price and the average price before losing momentum. This is another option as well. What do I mean by this? Let's go to the chart again. So for example, here I've got the average price movement. This is a 75 bar average price movement. So I'm basically, measuring the distance between the price and the average price when losing momentum. So this is where it lost momentum. So what's the distance between here and here? Again, this is where it lost momentum up here. So what is the distance between here and here? Now you can work that out using the cross tool on the MT5. That is also available on the MT4 as well. Because what you're going to do is you're going to get a breakout, and you're going to see that each time it gets 0.50% away from the average price, it tends to find resistance. Okay, if you're going to see a breakout and it's at 0.25, okay, happy days. Maybe it's something for us to consider. But if it's above, if it's at 0.60%, whereas normally it's at 0.50% that we lose momentum, again, that's not a breakout you want to take into consideration because it's outside of its traditional price movement. So another thing as well, of course, is if the trading session is about to change. A lot of the time you get the breakout when the trading session is about to change. A lot of the time it just corrects thereafter. So avoid those change of sessions as well. So that's something for you to take into consideration. We've got 3 slides left because we've already been speaking for an hour. I do apologize. I speak quite a lot. If people have questions, feel free to ask as well, of course, as always. Now, 3 price patterns, 3 very important price patterns for you to note. A lot of people say to me, I know these patterns, but I don't know if there's bullish or bearish. What's the signal? So the first is a head and shoulder. So what's the head and shoulder? It basically is when the price does this, 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 this. So you've got a high and 2 lower levels at the same price, more or less. This is a head and shoulder pattern. If you're going to get a head and shoulder pattern like this, it is a bearish signal. Now, if you're going to get a head and shoulder pattern that is a reverse head and shoulder pattern, so for example, like this, this. So it's the exact same, but it's reverse. It is bullish. So why head and shoulder? This is an example here because you got shoulder, shoulder, and a higher area, so a head here. So you can see it looks very much like a head and shoulder pattern. Now, it's bearish. Something very important, for example, if you see the traditional head and shoulder pattern here, is the neckline. So you can see a neckline here. Now, it might not look very clear as a support level, but if it crosses below there, that's an area where you can consider a potential trade. But the thing you need to be cautious about, if it drops below the neckline, you need to double check that it's not going to be oversold on the RSI, because it means there's been quite a lot of price movement downwards. The next is a ascending triangle. Now it could be an ascending triangle, it could be a descending triangle, which basically is neither going to fall into a bearish trend or a bullish trend, and that's why I'm mentioning it, because a lot of people want to trade the trend, but you need to be cautious that some things may look like a trend, but it's not a trend. So for example, here we have a descending triangle. People may say we've got a high, 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 high. Actually, on each occasion, the low is higher, the high is lower. So people may say this is a downward trend. It's not a downward trend. Why? Because look at the lows. The low is always at the same price until here at least, okay? So in order for there to be a downward trend, you must have lower lows and lower highs. A descending triangle is when, yes, you're getting lower lows and lower highs, so that's why you got the downward lines like so, but the lows are always at the same level, so it looks like a descending triangle. So how do we trade this? The breakout. It's not to be more bearish than bullish, but you could have a breakout in either direction. So if it, for example, broke above like this, that would be considered a bullish breakout, or you can have a bearish breakout like this. Now, there's also scenarios where you're losing momentum in both directions. This is known as a symmetrical triangle, which is this third chart here. So you can see the highs are lower on each occasion, but also the lows are higher on each occasion. So it's not a descending or ascending triangle, it's just losing momentum, becoming tighter, tighter, and tighter. Now, what does that indicate? That indicates that we're losing momentum. Normally after this, a symmetrical triangle, we get a burst, we get a lot of momentum afterwards, sometimes a very strong trend. For example, we can see this as well, just by a coincidence on this price movement, on this chart. Now, how can you use it? Again, breakout. Now, what I will say is with ascending, descending triangles, with symmetrical triangles, even with the head and shoulder, a lot of the time after breakouts of very well-known patterns, there is false break. There's a retracement, a correction. It's a false breakout. So wait, see the breakout. We've seen the breakout has happened. No problem at all. Wait for the retracement and then trade the continuation. That way you're avoiding the negative factor that it could be a false breakout, or we have to outlive a retracement, or we have to keep our course while it's retracing. Now the price condition, so we've got three key indicators for establishing the price condition. Now I've already mentioned the RSI. The RSI here is very important, very well known on an 18 period. Now the default period is 14. A lot of people use it on 14, but it's very well known by professional traders on the 18 period in terms of it being an indication of not oversold, overbought, but of price condition. So if it's between, for example, here between the 75 and 50, it's basically indicating bearish price condition, sorry, bullish price condition. And if it's between 50 and 25, it's bearish price condition. So for example, here we have indications that sellers are controlling. Here we have indications that buyers are controlling. What else can you use? Here, ladies and gentlemen, for example, we also have a 75 period exponential moving average. So the yellow is 75 EMA, 75 period exponential moving average. Here is a 100, the orange is a 100 period simple moving average. Then we've got the Ichimoku trading clouds here as well. So these are all well-known price indications. Got another question? I don't understand the question. How can I have access to replace what you wrote? How can I have access to replace of this lecture? So I don't quite understand that. Please rephrase, maybe ask again. I apologize. So these are all indications of price conditions. This is a 4-hour time frame on the US dollar against Japanese yen. What you'll notice is, especially if you look at not the Ichimoku trading clouds. So if we don't look at these Ichimoku trading clouds, yes, they can be helpful as well. But if you're just ignore them for the moment, you notice the price here, from here, it's almost always below the two trend lines, so the 75 and 100 moving average, all the way up to today's price movement here, or was yesterday was taken, but either way, you can see between that period, the RSI is always below 50 between here and below 50 between here. Now, if we look at those areas, so we're basically, the only area we're ignoring is from here to here. That's the only area we're not speculating downward price movement, because that area, the RSI is at the 50 and above. Also, at some point in this area, it increased above the trend lines as well. Now, if we ignore that area where it's saying not to trade, you can see it's indicating downward price movement, and you can see the sellers are very clearly controlling the market. So you can see how these these key indications are really helping us to understand and analyze the price charts and analyze that sellers, and to confirm that sellers are controlling the market. How can I have access to replay this lecture? It will be on YouTube on Thursday. So hopefully that helps. If you go to our YouTube channel, you'll see we'll have it available for you. The other thing we need to definitely keep an eye on is support and resistance points. So here we've got gold, a very well-known resistance level. So you can see we found resistance here, we found resistance here, same here, here, and here. What I will say is, when plotting support and resistance levels, try and have the average. So for example, you can see that sometimes it rose up to here, sometimes it rose up to here, sometimes it rose up to here, sometimes to here, sometimes slightly higher. So what am I doing? I'm looking at the average, okay? And then what I'm also doing is, as I'm speculating upward price movement, I won't aim for that resistance level. A lot of people make the mistake of aiming for that resistance level. And also educators online, they say, aim for that resistance level. There's disadvantages to that. So for example, if I was trading here, it would have gone up to here and the price would have started to move against me. That's not what I want. So if you're, for example, here, measure the distance to get to that resistance level, the average resistance level, and then aim for 75% of that. Okay, so if, for example, that is, let's say, a 1% increase, just an example, 1% increase. I won't aim for the full 1% to get to here. I'll aim for 0.75, for example, that may take me to here, because there's a higher possibility of hitting that resistance level. Sorry, of hitting your take profit. Somebody says, I would like more information on how to use Fibonacci to understand the retracement. Yes, of course, we can look at that on the MT5. So support and resistance levels, we looked at an example. Here I've said, for example, 70%. So aim for 70%. Each time the support and resistance point is continuously tested, keep in mind it may weaken. There is a higher possibility of it being broken. So for example, we've got a resistance level. If it keeps again and again and again and again being hit, at some point it's gonna break. Why? A lot of people say to me, why is that? And to be honest, it's to do with trader psychology. People are happy to take the price up to there, okay? And it's like, for example, if you're buying a house and somebody says to you, buy at 200, buy at 200, buy at 200, if people keep saying to you 200, 200, 200, at some point you weren't willing to buy at that level, but the psychology of your trading and your mind changes. You suddenly say, the prices are declining, everybody's telling me 200, so yeah, okay, I'll buy at 200. I'd like to buy less, but I've suddenly become more comfortable with that level. So keep that in mind in regards to support and resistance points. What I will also say is be cautious about the martingale strategy. A lot of people, they say this is the resistance level. As the price declines and further away from it, I'll buy. So people may say, I'll buy here, and then I'll buy here, and then I'll buy here, and I keep buying at a lower price. or maybe it's an upward trend, and I'm selling at a higher price. You know, selling, then I sell, then I sell, then I keep selling. You're trading against the trend. It's very dangerous, known as the martingale strategy. Very, very dangerous. You need to be cautious of that as well. Keep that in mind. One more thing to mention in regards to this. No, I think I've covered everything. Okay, great. I've covered everything here. Now, last thing I'll mention, candlesticks. And then we'll go on to the MT5 just to show a better understanding of how I use retracements and Fibonacci's. If you want more information only about Fibonacci itself and not the example we looked at today, then of course go to one of the webinars which are based on Fibonacci. So there's different candlesticks that you can look out for that give certain signals. The first one is known as the gravestone doji. The other one is known as the hammered doji as well. And also be cautious about change in momentum shown in the candlesticks. Now, what do I mean by this? The first is gravestone doji. So that's basically when you've got a body of the candlestick like so and a very big wick above. There may be a small wick below, but only small. Shouldn't look, for example, something like this, which case is not a gravestone doji. It needs to be a large wick above, body below, more or less no wick below as well. So for example, we've got a gravestone doji here. This, ladies and gentlemen, is a gravestone doji. It's an indication of downward price movement. So basically the price went somewhere and someone, basically the market sold it very quickly and it moved it against it, and that's why it formed a gravestone doji. So known as an indication of downward price movement. You can see here, you can also see here as well. It's a strongest indication where it's at the top of the impulse wave. So if it's a price range and you get a gravestone doji, it's not known to be a signal. If there's a big impulse wave and you get a gravestone doji, that's where it's known to be a signal. Also, if we do start to get, you know, let's say for example, we're moving upwards here, we've got a gravestone doji here, for example, the price started to decline. As the price increases, it's known to be a stronger resistance point here. Okay, so these where the gravestone dojis are, if you retrace and then starts to increase, it's known to be a strong resistance point. Then, ladies and gentlemen, you've got the hammers, the more or less the exact opposite, but downward price movement. So here you can see the downward impulse wave and you get the hammer. So you get a large body upwards and then a very large wick. Sorry, a small body upwards and then a very large wick. That is an indication of upward price movement. So it's the exact opposite. The other thing I wanted to mention lastly is the change in momentum. So look at this scenario here on the left. Look at this scenario. We've got one candlestick downward price movement, two candlesticks, 3, 4, 5, 6 candlesticks downward price movement. Let's say that's, for example, a 10-minute chart, 10-minute time frame, 6 candlesticks downwards, 1 hour. Look at the change in momentum. It took 1 hour to decline from here to here, and it took 10 minutes to increase from here to here, to go from the low to a higher high. So look at the change in momentum. This is something that you can take into consideration as well when analyzing trends, analyzing the price, analyzing the chart. So if people have questions, you can ask now. I will show you on the MT5 now. Somebody asked to see more information about how I use Fibonacci for retracements. What I will say again is, you know, we always look at 2 time frames, for example. So let's say, let me think of what asset to trade, not to trade, to look at, for example. Let's look at the Euro USD. The Euro USD is here, ladies and gentlemen. It's the asset which has the lowest fees, the most traded in the world as well. This is a 2-hour chart. We can see we're below both trend lines. We're below the 50 on the RSI, but we're not oversold. So clear indications of downward price movements. The only thing which is a slight concern is that we actually now ladies and gentlemen, on the lower low. So we can see this is the low, we've now gone to a low low. If we look at this low again, we're at the lower low. So there is a scenario potentially that we're going to see the price retrace back upwards. So there is that possibility there, because I know with experience when we form the impulse wave, it starts to retrace at some point. Whereas, for example, let's look at the example in regards to Fibonacci. So we've got a lower low, the lower high as well. So we know it's a retracement and we know we're still in the trend. We draw between the high, the low in this scenario because it's a downward trend. And we go to the high here, okay? So this is where we're drawing. Let's zoom in like so. And we can see the 65 level is here, ladies and gentlemen. This is the 65 level here that I've drawn on my Fibonacci. So rather than trade the breakout is all the way down here. Rather than trade the breakout here, you use the Fibonacci and trade that at an earlier entry. Now, some people will say, why would I want to do that? Because you're earning more quicker. So for example, the difference between the two is 0.08, especially short-term traders and scalpers. 0.08 may be their take profit. A lot of people on average may aim for a take profit of 0.15, 0.10, sorry, 0.20. That's half, or if it's 0.20, it's almost half. So it's a much better entry point, but only if it's not a very large retracement. Also, we can go into a 5-minute time frame, ladies and gentlemen. Let's look at a 5-minute time frame. Let's go to the Euro USD again. Euro USD, there we go. Let's look at retracements again. So here, for example, we've got a retracement. So you can see this is the high, this is the previous high, this is the low, this is the previous low. So we know it's a retracement because we've got lower lows and lower highs. Again, I draw between here, and I would have entered at the 65 low. So this is the 65 low. So instead of entering at the breakout here, I've entered at the 65 level. So this is a good example as well. So if anybody has any questions, feel free to ask them now. Somebody says, I would also like to do calculations instead of indicators. What do you mean by calculations? Calculating what? If you confirm to me, I'll be able to show you how to do so. Also, in regards to calculations, keep in mind this cross tool, which you have here, is very helpful. So for example, if you're measuring impulse waves, so for example, if you measure this impulse wave, going from here all the way down to here is 0.16. If you measure the previous impulse wave downwards, from here to here, look at that, 0.16 as well. So this is exactly why I'm saying it's always very, very good to measure the impulse wave. Measure the impulse wave to get a good understanding of the traditional characteristics and size of the impulse wave. Because I'm looking at 0.16, 0.16. Let's look at this example here, because we looked at this example, we looked at this example. Let's look at this example, because we've got both of them with 0.16. It's very rare for everything to be 0.16. This is 0.16 again. So to be honest with you, this is one of the few examples where it's pinpoint exactly always the same. Normally there's some slight difference. We look at an average, but this is a great example, 0.16, 0.16, 0.16, when I'm measuring and calculating the price action. So I know now, for example, this is an area where it could find resistance, because 0.16, it retraced, 0.16 on the second occasion, it retraced, now it's the third occasion, so now is it going to retrace again? I've got a lot of thank yous and good feedback, great. It's nice to hear, guys. Any questions? Somebody says using price action together with the very basic indications plus support and resistance could be a good approach. Yes, but look at momentum, because you can see what we're doing is we're looking at momentum. I'm waiting, you know, I can see, for example, there's downward momentum here, but I can't, let's say I can't yet see what's happening. So for example, I can only see, let's say here, I can see we're trying to gain downward momentum. I've got a high here, the high is lower. I can see the momentum downwards. I can see the crossovers downwards again. I can see this is the low. I can see this is the high. I want to trade when we gain momentum. So if it declines, for example, apologies. If it declines, for example, below the 65 level, so 65 level is here. That's where I'm going to trade. So that's where I'm trying to pinpoint where there's momentum. So I can see momentum gains, and that's where I trade. I enter my sell with plentiful in profits if that would have been the trade. So yes, price action indicators, yes, but very important to trade along with the momentum. So somebody says, can you please explain the impulse wave and breakout retracements in terms of price action trading? It's exactly this what I'm referring to. This exactly is price action retracement impulse trading. Let's look at a different asset. Let's look at, for example, should we look at the DAX, for example? We've got individuals that are interested. Gold, we can look at gold. Let's go to a clear screen, for example, like this. Let's go to a 5-minute time frame again. So here, for example, you can see we basically went from a higher high, a higher low, from this very strong high to a lower price. So we're now no longer in an upward trend on this time frame. We could form a head and shoulder pattern that we looked at, because it could go from here to here, in which case we've got two lows at the same level, and then we've got the head here. So it's a head and shoulder pattern. But is it going to form a retracement now and then continue upwards? Is what we need to think to ourselves. Because if it's it's at this price, if it's going to retrace maybe, for example, down to here, in which case it's a higher low, then it could be the continuation of the upward trend. So if it declines and retraces back to this level, we draw our Fibonacci like so. So this is the retracement, and then as the impulse wave goes to form again, then we've got the 65 level here for us to speculate the upward price movement. So if it increases above this blue line, then you can speculate the upward price movement. So we're trading the wave continuation rather than this impulse wave now, because that impulse wave is not on a higher high and higher low. So that could be just a retracement of a downward price movement, which is about to form. Potentially, we don't know. This is just based on technical analysis so far. So we need either for retracement to form and trade the continuation using Fibonacci or breakouts, or we need this to be the retracement, because this is retracing upwards. This is smaller than this, in which case we draw Fibonacci from here to here. And if the price declines below 65 here, that's where we're going to trade our downward price movement. So that's the end of our webinar. I can't see any other questions. So hopefully that was educational. In the meantime, ladies and gentlemen, trade safe, trade responsibly. Hopefully you enjoyed today's webinar. And we also will have a webinar tomorrow, and also on YouTube. You don't have to register for this. We have a live analysis while the CPI release is published. So the CPI inflation tomorrow will be released. There'll be a lot of volatility, and we'll be live on the MT5 analyzing it. So that will be very interesting. That will be on YouTube. It will be on our Twitter and our Facebook as well. So that's it for today. Enjoy the rest of your evening. Don't forget about tomorrow's live analysis session on YouTube. In the meantime, goodbye and enjoy the rest of your evening.